Hey everybody, here Brian Stevens with the National Real Estate Post. I'm coming to you today with Bill Kidwell. He's the president of the Impact Mortgage Management Advocacy and Advisory Group, also known as IMAG. Bill's been in the industry in some way, shape, or form since 1967. I've personally known Bill for quite a few years right now. He resides, I believe, still out in Denver, Colorado, or somewhere thereabouts. And what we're trying to do is bring you more voices with more opinions about things that are affecting everybody in the mortgage industry. Today, we're going to be talking with Bill for a few minutes about the myth of compliance, specifically how it's affecting the small mom-and-pop mortgage broker shop. But be aware, this is something that affects everybody. The thinking is if you're doing QM loans and you're sending them off, you're compliant. But Bill's got some thoughts about that. So, Bill, how are you doing today?
I'm doing great, Brian. How about yourself?
I'm doing great. So let's jump right in. The myth of compliance. Tell me about it.
Well, it's interesting. I focus on the target audience of the 12,000 companies that actually have 10 or fewer LOs. And in speaking with those guys, as we're talking about the issue of compliance, what I find most interesting is that almost to a person, they believe that if they're submitting loans to their lenders and the loans are being accepted and they're qualified mortgages, they've got the compliance thing buttoned down, as long as they've got a QC policy that matches the FHA requirements and their lenders' requirements.
Why is that not the case?
Well, what they miss is that the Consumer Financial Protection Bureau has a 900-page examination guide.
Okay.
Their expectation is that every company, regardless of whether it's a one-person shop or a 1,000-person shop, is going to have a functioning compliance management system that includes policies and procedures, but also has active things happening around it, such as training, monitoring, surveying, auditing, etc. And most of the companies don't have a clue about what that really means. When I'm talking to somebody on the phone about compliance, one of my first questions when they tell me we've got it all covered is, describe your written customer complaint policy to me.
Okay.
That really just gets a blank stare, because most people don't believe, I've never had a complaint. The CFPB really doesn't care that you haven't had a complaint. You better have a policy that anticipates what you're going to do with the complaint if you have one.
Yeah. Have you seen any type of enforcement actions on the small mom and pop broker shops right now?
Well, I mean, it's interesting if you confine it to just small broker shops. There's not a lot going on with the CFPB, because at the end of the day, there's 12,000 shops and only several hundred CFPB examiners. But when you expand it a little bit, in my state alone, just this year, a little used car dealership in Greeley, Colorado, population about 22,000 with about 22 used car dealers, was fined $700,000 by the CFPB because it wasn't properly disclosing APRs. Now, the disclosure didn't affect the consumer's cost of the deal, knowledge of the deal, or anything, but they had administratively made a mistake. Small used car dealership cost $700,000. There's an event in North Carolina, which isn't directly the CFPB, but it's a regulator who's enforcing the CFPB's rules. There was a two-person shop there. They had some minor RESPA violations that really didn't harm consumers, but they were administratively against the rule. They were only fined $3,500.
Okay,
But their licenses were suspended for 7 years.
And that's, in the truth of the matter, is we just saw recently that the CFPB is now using secret shoppers. We have seen outside of mortgage lending that they're going into the auto industry and even with student loans and payday loans and a variety of different areas. And so their enforcement seems to be expanding right now. Okay, so just real quickly, in a couple of seconds here, what does somebody need to do if they're a small mom and pop broker shop and they say, we don't have the money, we don't have the bandwidth in order to deal with some type of compliance? What's their answer?
Well, clearly, I mean, compliance is potentially an expensive proposition. What they need to do is they need to look inward, figure out what it takes to simply get the documentation in place. And, you know, I don't mean this to be self-serving, but if they want to give me a call, we offer a program that's targeted at the 1 to 10 person shops. It's comprehensive. It's customized to their business practices. Long onboarding process to make sure we've got what they're going to use on the shelf usable so that they'll actually act from it because it's written to their practices and their risk tolerances. And they can get that for something that's very affordable. And they don't have to go out and, you know, you can buy the documents from Allreg right now. for $11,000. Most guys in the 1 to 3 shop can't afford that. So all we've done is try to put a program together that will allow the small shops to, our tagline is make competing and compliance compatible.
Gotcha.
So we give the compliance to you based on your needs, and then you can go generate revenue.
Okay, let's switch gears here real quick. Speaking of the CFPB and speaking of compliance, I mean, it's been the big issue, the hot topic debate for the first part of 2016. Going forward, we have Altai Financial, which has been a big case. There's been some pushback. We're seeing the case with PHH right now, which is being contested in the courts and seems to be doing fairly well. You find a vocal group within the House and the Senate right now that are trying to push back the CFPB. The Heritage Foundation, we know, is trying to repeal Dodd-Frank. Good luck with that one, along with a number of our other House representatives. Where do you see, with the election coming up and all this attention at the CFPB, where do you see this whole thing in 6 months, a year from now?
I would say in 6 months, status quo. We're not going to see any change in 6 months, with the exception that we're all going to have a bite at the apple to talk to the CFPB about TRID and about how that particular rule is affecting people. In fact, I've been invited to talk to them next Monday morning at 8 o'clock. I think they'll take that, and so for 6 months, we'll see them deciding if they're going to make some changes to TRID. I think after the election, there's some potential to make some, to remediate Dodd-Frank's impact a little bit. I mean, you know, you've got Posey down in Florida, who's got HR 3393 that's trying to take a bite at that 3% cap that only affects non-self-funding brokers. I think we're going to see those kind of actions, but I think really in the next 18 months, you're not going to see much change in what we're facing coming from the CFPB.
Now, so compliance aside, this is kind of a hard one. What's the biggest challenge that you see for your mortgage broker, small regional shop out there, again, the next 6, 12, 18 months?
If we're talking about the non-self-funders that are, you know, that's my primary audience, the 12,000 noses that are running small companies, probably the most difficult thing for them is trying to manage the variety of lender interpretations of TRID and trying to make sure that they've got everything buttoned down so that their consumers are having some kind of a decent experience instead of being, you know, kind of false start, false stop along the way, because each lender obviously is interpreting TRID differently. And that has an effect on the loan estimates. It has effect on the process of revising loan estimates. It has effect on disclosure processes, creates a lot of consumer confusion. I think that's probably the biggest problem most brokers are facing right now, is how do I get my consumer to experience a decent process? And I don't know which process I'm going to put them into till after we've talked, and then I have to choose a lender.
Okay, last question here, and again, we're getting off script a little bit, but I think it'd be interesting to hear your opinion on it. In the last 12 months, we've seen a lot of Altai loan programs come in, you know, high LTV. We've even seen some stated income stuff. I happen to like it personally. I think it's offering consumers responsible products who are on the outside looking in. Do you have any thoughts on some of the Altai products? Do you think they're going to continue going? Do you think it's healthy? And do you think there's going to be some type of enforcement action against them?
Yeah, that's a tough question. Yes, I think as long as there's capital out there, there are going to be innovative people to try to find a way to put that capital to good use. That implies that Altais are going to be available again. I think if Altais are managed like they were before 2003, before we opened the Altai world up to people that couldn't even qualify for subprime,
right.
As long as we don't see Altais attempt to stick their toe in the, you know, in the prepayment penalty water at all or deeply, you know, I think they have a shot. I think they have a real shot to move forward. I think that given the CFPB's challenges just with staffing and trying to do the things they're doing, I think they'll be able to get some traction before they get a lot of enforcement attention. But I promise you, the first time a consumer rings the phone or hits the email to the CFPB's complaint line and says, I just got tattooed by an Altai lender, there'll be an examiner looking at that.
So you're counsel for somebody right now. Look, and again, this is one person's opinion here. So Please, whoever's watching this, if you disagree, you can go ahead and save a nasty email because it's duly noted. But would it be fair to say that your counsel at this point would be, I would probably steer clear of this until we get some type of direction?
I don't think so. I mean, okay. I think if as a professional, and let's face it, I mean, we're down now to a manageable core of about 60,000 active LOs working in fewer than 16,000 companies. These guys are the guys that kind of get it. They survived and they're trying to prosper again. I think that same characteristic, if they vet the lender that's offering the program and get a good sense of the lender's approach, and if they realize that whether it's Altai or not, we have the responsibility to prove ability to repay. That's not new. The government didn't have to tell us that. Right. We all did that. Those of us who are still around did that before. So I truly believe if there's an Altai program out there and you can vet it and the lender properly, you've got a customer it may fit. And if you can serve that customer, I think it's the right thing to do.
Bill Kidwell, thank you so much for your time.
Brian, thanks so much for inviting me. Have a great weekend.
You too.